Hello everyone. In the previous class, we studied about GAAP, that is Generally Accepted Accounting Principles. We studied about accounting standards. We also looked into the meaning of INDES, that is Indian Accounting Standards, and we also learned about IFRS, that is International Financial Reporting Standards, and about IFRS compliant. In that, we learned that India is IFRS converge, not IFRS adopted. So, in today's class, we are going to start chapter number 1 of corporate financial reporting. So, the chapter number 1 is about accounting standards. So, in the previous class, I have already gave an introduction to accounting standards. Let's revise that once again. So, in the previous class, I told you the meaning of standard. So, what is a standard? A standard means principles, or we can say in our easy language, that is rules. So, here a standard means a generally accepted model or an ideal. So, model, we can say a model or an ideal, or we can also say some principles, some rules and regulations. So for what purpose we are adopting these accounting standards, for what purpose we need these principles? We need these principles to prepare our financial statements. So for everything, for our managing of our day-to-day life also, we are preparing some timetable, we are framing some life rules to go easy. So like that only, in order to prepare our financial statements, there are some rules and regulations issued by an authority. So here accounting standards are generally accepted models, generally accepted by some countries. These are some rules and regulations that must be followed if you are preparing the books of accounts. So thus accounting standard means a generally accepted accounting principles. So in our easy language, we can say these are the rules, these are the principles that we must follow for preparing the books of accounts. So any business concern, any accountant, if he wants to prepare the books of accounts, if he wants to prepare the profit and loss account or balance sheet or statement, any kind of statement, the set of rules and regulations given for the specific statement that must be followed. So here accounting standards, these are written documents. So these rules and regulations, we will get this in a written form. So these are the written documents containing generally accepted accounting principles. So GAAP. So GAAP covers everything. I told you in the previous class, GAAP covers AS, INDES, IAS, IFRS. So everything covers in GAAP only. So what was GAAP? GAAP was generally accepted accounting principles. So each and every country has separate rules and regulations for preparing their specific books of accounts. For example, UK, USA, India. So UK, what rules and regulations UK has adopted? So these European countries rules and regulations are being followed by some other countries also. So these are generally accepted accounting principles, international GAAP. And the rules and regulations which are followed in India, this is national GAAP. So simply, what rules and regulations specific country is adopting, which is followed in specific country only, that is called as national GAAP. If the rules and regulations followed in one country, that same rules and regulations are being followed in another country, so that is called as international GAAP. So which is the institution which makes this accounting standards? So ICAI, Institute of Chartered Accountant of India, this is an institution with accounting standard board, that is ASB, with association of ASB. ICAA is the institution in India which is responsible for issuing the accounting standards. So as on date, 32 accounting standards. As on date means before IFRS, before India's introduction, the total standards was 32. Now, what is the purpose? For what purpose we are adopting or we are following these accounting standards? So it is to standardize the different accounting policies. So see here, our trade, doing business, has become irrespective of boundaries. We are trading from one country to the another country. So if we are trading with different countries, if we have a business with a different countries, so we need to look into the statements of different countries. So if one country is rules and regulations is different from other countries, then this country, for example India, this is US, this is China, and this is UK. So if these countries, India is trading with these three countries, or we can say these three countries are trading with India. So ASA, what rules and regulation USA is following, those rules and regulations are not followed in India. We are following different rules and regulations. So what rules and regulations China is following, that rules and regulations for preparing the financial statements, that rules and regulations we are not following. Same in case of the UK also. So here the problem arises is the USA people or UK people, the abroad people, our investors, they are unable to understand our financial statement. I already told you in the previous class, what we are mentioning, what they think as an asset, here it may show as a expenditure. What they think as a liability, it may show as a income in our financial statements. So in order to overcome this problem, in order to reduce this problem, to standardize, to bring uniformity in the rules and regulations, the accounting standards were introduced, and that must be followed by the business concerns for increasing their foreign investments. So if you want to invest in any fund, if you want to invest in any company within India only, domestic trade only, if you understand their investment criteria, their return policy, then only you can believe them and you can invest your money. You will feel that your money is safe and you can be confident about your investment. Unless you are confident, unless you don't feel comfort with the specific company, with specific company's shares, you won't invest. Like that only, if you want to increase our foreign investment, India must bring a uniform accounting policies, and it must eradicate the problem of diversification in the accounting policies. So that's why the accounting standards, or we can say that GAAP or Indian accounting standards or IFRS was introduced. So let's revise the meaning of accounting standards. Accounting standards are the statements. I told you these are the written statements or a code of practice, a code of conduct, a code of a set of rules and regulations. Who are preparing these rules and regulations? These rules and regulations are prepared by a regulatory authority. These regulatory accounting bodies that are observed in preparation and presentation of the financial statements. So who are these regulatory authorities? I already told you, Institute of Chartered Accountants of India with Association of Accounting Standard Setting Board. Next is definition of accounting standards. So we'll study the definition given by Institute of Chartered Accountants of India only. So according to ICAI, accounting standards are written documents These are the written documents. These are policies, procedures. These are written documents, written rules, a set of procedures, a set of steps issued by expert accounting body or the government or any other regulatory body covering the aspect of recognition. So here first point is recognition. So what is this recognition? Recognition means identifying an asset or a liability, or we can say an income or an expenditure. If one transaction has happened, we have to recognize whether that transaction is bringing profit for our company or it is a loss for our company, whether it is an asset for our company or a liability for our company. So the first thing is we have to identify, we have to recognize the transaction. So for recording our transaction, first of all we need to recognize the transaction. So that is the steps they are providing. Is first step is recognizing. How to recognize an asset, how to recognize one transaction, whether it is an income or an expenditure, whether it is an asset or a liability. So that is the rules they are providing. Next is measuring. So after you have recognized, after you have identified one transaction, for example it is an income for your company, it is a profit for your company, the next thing is you have to measure it in terms of the money, in what percentage it is bringing profit for your company. So in terms of money, if you are measuring, that is called as measurement. Next is treating. So after we have calculated a value, we need to know where we should put in the financial statements, that is treatment of the treatment of the transaction. So income, it is an income for us, means in profit and loss account, where we have to show, that is treatment. The set of rules and regulations that will be there in the written form that we have to follow and prepare the financial statement. Next is presentation. After knowing where we should treat it, next is how to present it. How to present it means how to prepare the financial statement. Next is disclosure. Disclosure means providing the necessary information for the financial users. The financial users, or we can see the stakeholders. Who are the stakeholders? So it is a very common word, I can say it is stakeholders. Stakeholders are all those people who have shown an interest for our company's well-being. It may be our employees, it may be our creditors, it may be financial institutions, it may be the directors, it may be the owners. So everyone, every financial user, for them if we are providing the information, so how we should provide that information of accounting transactions in the financial statements. So this is what accounting standard means. In the simple words, these are the written documents which has some rules and regulations for recognizing, measuring, treating, presenting and disclosing the information to the financial users. So hope you have cleared with the definition, meaning and introduction of accounting standards. So let's look into the advantages. So what are the advantages if you are following the accounting standards? So the first advantage we can say is for accountants, for accountancy profession, they provide a set of working rules. So if the accountant or every person who has an accounting profession, auditors, accountants, or anyone who is working in the financial sector, for them they have one set of written rules, written documents, working rules that they can understood, they can follow and they can prepare accordingly the financial statements. So that is the main advantage. Next is it improves the quality of work performed by the accountant. So if accountant is not cleared with the accounting standards, if he is not clear with the principles, he may not perform his work that much more he may not produce the work more qualitative. So if he understood, if he has rules and regulations, if he has certain accounting standards, he may follow them and he can improve his quality of work. That is another advantage. Next is crystal clear information. So crystal clear information means for the financial users, the users of financial statements, it may be anyone, it may be the creditors, it may be the financial users, it may be financial institutions, it may be the debenture holders, it may be the other investors, it may be the shareholders, it may be the owners, any person, anyone who is using the financial statements. For them, they provide a crystal clear information without any barriers. So from time to time, whenever they need information, they can have an access to the information. That is a third advantage. Next is strengthens accountant resistance. So here accountant resistance, so earlier, when rules and regulations, accounting standards were not there, the business organization, or we can say the directors used to prepare the financial statements according to their needs. They used to provide the fake information also. But after the introduction of the accounting standards, they must have to follow the rules and regulations, and they must provide the true and the fair information. So here's more pressure. The directors used to provide more pressure for the accountants to provide the fake information. So here, after introduction of the accounting standards, the accountants resistance against the pressure from the directors for using the accounting policies in preparing the books of accounts has strengthened. Their we can say one kind of strength has given to the accountants to prepare the financial statements according to the rules and regulations. The last benefit is comparison of the financial statements. So one or two businesses who are doing the same kind of or same type of business operations, so if these business companies are following the same rules and regulations, so one or two businesses doing same business and they are following same rules and regulations, means we can easily compare these business, two or three businesses, and we can bring the report easily. So that is comparison of financial statements of two or more business organization has become easy after the introduction of the accounting standards. So these are the advantages. Disadvantages. So the disadvantages are, first one is infallible. So infallible means without being wrong. So here infallible. So here users, the financial statements users, they usually think that whatever these statements prepared by following the accounting standards, they are without any mistakes. So without any mistakes, we are getting the fair and the true information. But even if the accounting standards are followed, still there is some doubt that the information which is provided in the financial statement is not that much fair. So here infallible, without being wrong. What is without being wrong, which is think by the users of the financial statements, is not that much true. That means some of the information will be true and some can be fake. Next is reduced freedom. So I told you in the advantages, accountants resistance has strengthened. So directors or the business organization, those kind of business organization who used to produce the fake information, 100% fake information or 90% fake information in the financial statements, their freedom has reduced. They must and should follow the accounting standards to some certain extent. So next is working rules may be rigid or bureaucratic. So here rigid means inflexible. So what the accounting standards which is framed by the Institute of Chartered Accountants of India, that rules and regulations are not flexible, or it is bureaucratic means these rules and regulations are prepared by a regulatory authority, or it is prepared by the government, it is prepared by the government order. So changing the rules and regulations, bringing flexibility in the financial statements, bringing flexibility in the working rules is not easy. It is rigid, it is not flexible. Last is makes financial statements costly. So how, if the accounting standards are followed, means the financial statements become costly, means the normal accountants, they may not easily understands the accounting standards. So these accounting standards are understood by the chartered accountants only, and we know that chartered accountant fees, paying them fees, paying the auditors fees is obviously costly. So here indirectly financial statements becomes costly if we are following the accounting standards. So this is all about today's class. So in this class we have revised about GAAP, we have learned meaning and definition of accounting standards, and also we have learned about the advantages and the disadvantages of the accounting standards. So in the coming class we are going to study the types of accounting standards, and we are also going to study the what are the procedure in setting the accounting standards, and what is the difficulties the regulatory authority finds come across the while preparing the accounting standards. And also we are going to study about some institutions who are engaged in making the accounting standards. So if you have any doubt in this today's class, you can ask me in the comments below, or you can ask me in your WhatsApp group. Thank you for watching, for listening this class. If you have any doubts, you can contact me. Thank you.